You have 6 months of expenses saved in your bank account, and that's exactly why you're vulnerable. Most people spend years building their emergency fund. They celebrate the milestone, they sleep a little better at night, they feel protected, and then they never stop to ask the one question that actually matters: protected against what exactly? Because here's what almost nobody in personal finance will say out loud. If every dollar of your emergency reserve sits inside a single banking institution, you haven't built a safety net. You've built a building with one fire escape. Think about what a fire escape actually does. It's not there for sunny afternoons. It exists for the moment when your main exit is completely inaccessible, when the stairwell is filled with smoke, when the door is jammed, when the ground floor is already compromised. A building with only one fire escape doesn't fail on ordinary days. It fails on the exact day you need it most. Your single institution emergency fund works perfectly in every scenario except the one where you actually need it to work. That's not a hypothetical risk. That's the definition of a single point of failure. Let's get precise about what the word accessible actually means. Not in theory, in real life under pressure. Your money in a savings account is accessible because your bank agrees to give it to you when you ask. That's the agreement, and under normal conditions, the bank honors that agreement without any friction whatsoever. But here's the thing about emergency funds: they don't get triggered during normal conditions. Think about what happened in March 2023 when Silicon Valley Bank collapsed within 48 hours. Tens of thousands of businesses and individuals held accessible funds. The money was there on the balance sheet, the accounts were real, but for 2 business days those funds were functionally unreachable. The building had one exit, and the exit got jammed. Now your bank is almost certainly not Silicon Valley Bank. Most primary banks carry far more stability, but this isn't really a story about your specific bank collapsing. It's about something quieter, something that happens far more often, and something that almost no financial advisor ever brings up in conversation. Here is what economists call the liquidity paradox. In a stable economy, your bank is liquid, it has your money, it can pay you on demand, everything functions exactly as advertised. But when a genuine crisis hits, the kind that actually triggers emergency funds, the nature of access itself changes. Everyone needs their money at the same time. Banks, even healthy ones, experience institutional pressure. And the digital systems that money travels through, the ACH network, the payment processing infrastructure, the debit card ecosystem, start experiencing exactly the kind of stress they were never designed to handle all at once. This isn't catastrophizing. This is how the financial plumbing actually works. In 2012, during Hurricane Sandy, ATMs across major metropolitan areas went dark for days, not because the money disappeared. Not because banks failed, because the grid was compromised, the accounts were fine, the access was not. Let me ask you something uncomfortable. If your debit card stopped working tomorrow, not from fraud, but from a straightforward system outage at your bank, how many days could you and your family function on the physical cash currently in your home? For most households, the honest answer is less than 24 hours. That's not a poverty problem, that's an architecture problem. Here is the shift in thinking that changes everything. Liquidity is not a property of money, it's a property of access. Read that one more time. Liquidity isn't about how much you have saved. It's about whether you can actually reach it, move it, and use it right now under pressure when the systems around you are stressed. $1 million in a frozen account is not liquid. $1,000 in physical cash in your kitchen drawer is perfectly liquid. The number is irrelevant. The accessibility is everything. This is precisely why institutional investors, pension funds, sovereign wealth funds, university endowments, never hold their entire reserve position inside a single institution or a single financial system. They call this counterparty risk. It's the risk that the other party in your arrangement, in this case, your bank and the payment infrastructure it depends on, cannot fulfill their side of the agreement at exactly the moment your need is greatest. And they manage counterparty risk by diversifying not just what they own, but how they own it and who controls access to it. Your emergency fund carries the same exposure. You've simply never been told to think about it this way. Now here's where the pressure becomes real, because this isn't only about catastrophic scenarios. The actual cost of keeping everything in one place is accumulating right now, quietly, every single month. The average high-yield savings account today pays somewhere between 4 and 5%. Real inflation, depending on the measure, runs between 2.5 and 3.5%. So your emergency fund is generating roughly 1 to 2%, in actual purchasing power terms. Meanwhile, non-bank money market instruments, treasury bills held directly through the federal government, money market funds housed at a brokerage, are offering similar or better yields within a completely different risk architecture. You're not getting a better deal at your bank. You're getting the illusion of simplicity at the cost of systemic concentration. And the psychological cost is harder to quantify but arguably more damaging. When all your reserves exist in one place, your entire sense of financial security depends on one institution, one app, one debit card, one digital network, performing correctly simultaneously under pressure. That's not security, that's dependency dressed in the language of security. Let's say the worst case isn't a bank failure. Let's make it something far more ordinary because ordinary is actually more instructive. A billing dispute freezes your checking account for 72 hours. A fraud alert locks your debit card over a long weekend. Your bank's mobile platform goes down during a regional storm. None of these scenarios are extraordinary. All of them happen every year to millions of people across this country. And every single one of them reveals the same architectural truth. Your emergency fund is only as strong as the single system it lives in. If your only fire escape requires electricity to open, you don't have an emergency exit. You have an emergency illusion. Here is what genuine financial resilience actually looks like in practice. Not paranoia, not extreme preparation, just applied common sense, the same logic institutions have used for decades. It's called a hybrid buffer. Instead of keeping 100% of your emergency reserves inside one banking environment, you deliberately split it across 3 independent systems. Roughly 30% stays in traditional banking, your checking and savings accounts, because convenience matters and day-to-day function requires it. This portion handles immediate access for the small emergencies, car repairs, medical copays, utility spikes. Another 30% moves into what you might call parallel systems. Treasury bills purchased directly through Treasury Direct, Gov, non-bank money market funds held at a brokerage account, or similar instruments that carry competitive yields while sitting entirely outside your primary banking relationship. This money is still highly liquid, accessible within 1 to 2 business days, but it operates through a completely different institutional infrastructure. And the final 40% lives in what you could call absolute sovereignty. Physical cash kept in a secure location in your home, enough to cover 4 to 6 weeks of essential expenses. Possibly supplemented by a small allocation to precious metals or other assets that function entirely without digital infrastructure. This isn't fringe thinking, it's the emergency fund equivalent of owning a generator. What this model guarantees is that no single point of failure can make all of your reserves simultaneously inaccessible. If your bank has a system outage, your money market fund still functions. If the ACH network is stressed, your physical reserves still work. If one of your 3 systems is under institutional pressure, the other 2 are, by design, architecturally independent of that pressure. This isn't complexity, it's redundancy. And every building built to code has multiple fire exits for exactly this reason. Once you internalize this, it becomes impossible to unsee it. The question stops being how much do I have saved, and starts being through how many independent systems can I access what I've saved. The dollar amount doesn't change, the architecture does. And the practical steps are simpler than you might expect. Opening a Treasury Direct account takes approximately 20 minutes and costs nothing. Building a physical cash reserve, 2 to 3 weeks of essential expenses, kept in small denominations in a secure location at home, requires no financial expertise and no broker. Shifting a portion of your savings into a non-bank money market fund can be done inside a brokerage account you likely already have. None of these moves demand significant capital restructuring. All of them require only a fundamental shift in how you define the word safe. Your emergency fund was the test case, but the same principle applies to every financial system your household depends on. Your income, how many independent sources does it have? Your payment infrastructure, how many different ways can your family pay for something if one channel goes down? Your investment accounts, how many custodians hold your assets? True liquidity is the ability to act under pressure. And pressure, by definition, is exactly when single points of failure stop being theoretical and start being very expensive. The building was always fine, right up until the one day it wasn't. Start counting your fire escapes.